Bill Gates is one of the world's wealthiest people and the founder of Microsoft. He is also incredibly engaged on the global stage with climate change and public health issues around the world through the Bill and Melinda Gates Foundation. However, in 2020, he became a much more controversial figure as he has become more involved with COVID and the global response to it. He seems to be appearing all over the world, discussing his views on what the future should look like and funding projects he thinks humanity needs. Regardless of the public opinions on him, I think it's incredibly interesting and insightful to see how he is managing his money and what he is doing with his portfolio. He is someone who is very well educated on the issues surrounding our globe both now and in the future, so seeing where he is placing his money could help us see what he is thinking. In today's video, I want to take a deep look into his current portfolio and discuss what he has been buying and selling recently. I created this very quick spreadsheet from information found on his foundation's SEC filings and found the stocks he has been buying and selling. What I noticed is that Bill Gates has been doing a lot of selling. In fact, there's only one position that he's been adding to. This company is Schrodinger, and we will get into why I think he is building this position later on in the video. But first, I want to discuss why he is selling so many well-known stocks, and one of them being his largest position, Berkshire Hathaway. So let's start from the top and work our way down. The first stock that Bill Gates sold is Alibaba, and he sold out of this stock completely. Alibaba has been dropping due to the Chinese government cracking down on big tech across the country. China thinks that their tech companies are becoming too powerful and influential on Chinese society, and are also presenting monopoly-like business models. China is not okay with this, and has actively been working to harm these businesses. The political issues with big tech in China are really the only reason I see Bill Gates selling this stock, because despite all of this political drama, Alibaba's fundamentals have been growing like crazy. For example, in Q4, they reported a record quarter and massive growth. They finished 2020 with a record year as well, and the business's fundamentals seem stronger than ever. So Bill Gates selling signals to me that he thinks the Chinese government is going to continue cracking down on their big tech companies, and that this will ultimately harm the future profit potential of the business. However, there is a seriously strong argument that Alibaba is currently undervalued, and is a great way to gain exposure to the growth of the Chinese economy. But ultimately, it does seem like Bill Gates is more concerned with the political tensions and would rather sell out of the position entirely. The next stock is Alphabet, which is also known as Google. Bill Gates has trimmed this position by about 50% across both the Class A and the Class B shares. There are two main reasons why I see Bill Gates selling Google, and the first is because the stock is getting quite expensive. Google's price-to-earnings ratio is sitting at a 5-year high if you ignore the earnings compression the company saw in the second half of 2017. In 2016, Google's price-to-earnings was high at 33, and today it is sitting at 35, which again is historically expensive for this stock. The price to sales is also sitting at a 5-year high, along with the price to book. So I don't think that it's an awful idea for Bill Gates to trim this position, but it does look like he is missing out on some of Google's recent rally. The second reason that I see Bill Gates trimming Google is because of the rising interest rate risk. Interest rates are set to follow whatever bond yields are doing, and bond yields are currently spiking over the fear that we are going to see some increased inflation soon. If bond yields are spiking, then people worry that the Fed will start increasing interest rates to follow them. Warren Buffett also says that interest rates act like gravity on stocks, and the higher interest rates go, the low price to earnings will be across the market. So Bill Gates selling his high-flying stocks tells me that he thinks they're either overvalued and/or he believes rising interest rates will bring the price ratios back down to historical averages. Regardless, I must admit it is pretty surprising to see him selling a stock like Google that is leading the way in tech and seeing a very strong fundamental growth. Next up on the list is Amazon, and again, he sold 50% of his position in this company. What's interesting about Amazon is its PE actually isn't that high relative to the company's history. Yes, the price to earnings ratio is over 70, which in general is very high. But if we take a look at Amazon's history, the price to earnings ratio has pretty much always been over 70. Amazon's current price to earnings ratio is actually lower than where it was back in June of 2020. The price to book ratio for Amazon is also sitting at a reasonable level based on historical averages, and the price to sales ratio is below where it was in 2018, although the price to sales ratio I believe is still quite high. Basically, what I'm trying to say is that Amazon's financial ratios aren't ridiculously high relative to where they have been in the past. So it's quite interesting to see Bill Gates trimming this position. One argument for this selling could be that Amazon is benefiting heavily from the online world we are currently being forced to live in through COVID. There is no doubt that Amazon's business is benefiting from the current global situation, and once the world opens up again, their business may see a small dip in sales. However, analysts are quite bullish on Amazon, and they're projecting continued and steady growth for years to come. What this means is that people are not expecting the current economic environment to be a short-term catalyst for Amazon, and they are expecting the growth to continue after COVID is done with. So why is Bill Gates trimming this position if growth is going to continue, and if the price of Amazon isn't that insane? Once again, just like with Google, it's most likely because of interest rates increasing and compressing price-to-earnings ratios on high-flying stocks. There is one other reason I could see, but we will get into that later on in the video because it could apply to every single stock he is selling. Alright, but next on the list is Apple. Now, Apple is in a Google type situation where the stock is quite expensive right now. Out of Apple, Amazon, and Google, I would actually say that Apple is currently the most expensive. Their price to earnings ratio is sitting well above a 10-year high and is now sitting at 32.32, and historically it has traded at or below 20, which I have to admit is quite surprising. Apple's price to sales, price to book, and price to free cash flow are all sitting at very, very high levels too. So I don't think that it was an awful idea for Bill Gates to trim this position down while the stock is selling for historically high premiums. Analysts are expecting Apple to continue growing long term, but I still think that Apple is selling for very high premiums. And it is a stock that could be at a huge risk if interest rates do start rising, and high price to earnings ratio companies start coming back down to historical averages. I also think that Apple's projected growth does not justify the premiums that it is currently selling for. So personally, I don't think that this was a bad sell on Bill Gates' part, and I don't think that I would personally be buying Apple at these prices today. Next on the list is Berkshire Hathaway, and I have to admit that I was incredibly surprised to see Bill Gates selling the stock. For those of you who may not know, Bill Gates and Warren Buffett are very close friends, so to see Bill Gates selling nearly 10% of his Berkshire position, I thought was kind of strange. What's even more strange is Bill Gates is selling these shares while Warren Buffett is buying back tens of billions of dollars worth of shares. Warren only buys back shares when he believes that Berkshire stock is undervalued. So here's what I think. Berkshire is Bill Gates' largest position by far. He actually has over 40% of his portfolio in this one stock. If Bill Gates is looking to manage his portfolio and not allow Berkshire to become too large of a position, then he may sell off some of his Berkshire with his other stocks to prevent the position from making up more of his portfolio. I have actually done this in the past too, and sold off a stock that grew into too large of a position, and ultimately I had to trim it down because it became uncomfortable. This very well could be what Bill Gates is doing here, because I don't think that Berkshire is a bad stock to own by any means, and I don't think that Bill Gates selling it necessarily says anything. Honestly, I just think that he's balancing his portfolio. Next is Boston Properties. Boston Properties is a REIT that provides a nice dividend of 3.81%. They are the largest publicly held developer and owner of office properties in the United States, and their offices are mostly in 5 markets: Boston, Los Angeles, New York, San Francisco, and Washington, D.C. I think it's pretty clear why Bill Gates liquidated this position. Companies are moving their operations online, and the need for office space has seriously declined in the last year. Major companies like Facebook and Twitter are also saying that they are moving a portion of their workforces to permanently online, which will seriously harm the office rental market in major cities. The way I see it is, if a business can save money by having less office space to rent, then they will. COVID accelerated the move online and remote working for businesses, and BXP is currently seeing this in their fundamentals. In 2020, their revenue took a serious hit, and the hit is continuing to come. In Q4, they reported less revenue than in Q2, when COVID was first becoming a major issue and lockdowns were the widest. So Boston Properties is not recovering very nicely to their pre-COVID levels of revenue and cash flow, and long-term, I am not optimistic that they will. To put it simply, I would not want to be invested in office real estate right now either. Bill Gates understands technology and how it can shape our future, and I think that he is seeing that office space is going to be in low demand even after we get COVID under control. So it makes complete sense why he is selling this REIT. Next is Canadian National Rail, but it was such a small sell of his that I don't feel it's significant enough to discuss. It was near a 1% trim in this position, which I just don't think is anything major. So let's continue on. We can see that he sold out of Liberty Latin America. This is a telecommunications company. They provide internet, broadband, and a basket of different communication services to nearly 20 countries around the globe. Now, when I initially started taking a look at this business, I thought it could actually be reasonably valued, or a potential turnaround investment. The stock has been selling off consistently since 2015, and is down about 70% from where it was selling just 6 years ago. I also noticed that in Q4 of 2020, the business did over $1.1 billion in revenue. However, it is still struggling to become profitable. They also did an acquisition in Q4 that cost the company $1.8 billion, which could help explain why the revenue saw a spike in that same quarter. What I also noticed on the cash flow statement is their debt repayments have been much higher than the amount of cash the business actually brings in. In 2020, they were paid $1.439 billion in debt, yet the business's operations only brought in $640 million for the year. This ultimately tells me that the company has a lot of debt, and they're actually taking on new debt to pay off old debt, which is seriously harming the profitability, which could help explain why investors are fleeing the stock. So to me, it looks like Bill Gates is recognizing what is going on with this business and trimming back his position. It also wouldn't surprise me if he wasn't a fan of their nearly $1.9 billion acquisition in Q4. Personally, I would have rather seen that money go towards paying off the debts and getting the business closer to profitability before expanding. And ultimately, it would not surprise me at all if Bill Gates continues liquidating this position more in the future. Now lastly, Bill Gates totally sold out of his Uber position, and I fully agree with this decision. Uber is a cash-burning machine that just cannot seem to get to profitability. They have been consistently raising more debt and burning their cash pile just to stay in business. Now yes, 2020 was obviously a hard year for them, but I am still not a bull on this business, especially when it's trading at a $100 billion valuation, losing revenue, and about $3 billion annually. I think this was Bill Gates' speculative position, and I think that he is selling it for all of the obvious reasons, and especially because if interest rates do in fact start rising, then speculative stocks like Uber could get hit quite significantly, especially with the high amounts of debt the companies carry. Now finally, let's get into the one position Bill Gates has actually been buying. Again, this company is Schrodinger, and this is a company that helps develop drugs through software. They also have a few of their own clinical trials going on right now, but currently they get the majority of their revenue from their software services. Their software uses physics to help discover new molecules for drug development and applications. The company has also been seeing great growth over the years, and has doubled its revenue from 2017 to 2020. They're also projecting revenue growth of another 20% in 2021, so people must really be finding their software beneficial. However, they are still quite unprofitable, and they are selling for near 50 times revenue, which is incredibly expensive. It seems like investors are betting that SDGR is going to seriously help the healthcare sector with their software, and Cathie Wood has also been buying shares of this business. Recently, on March 4th, the stock dropped pretty dramatically when they announced their Q4 earnings results, and that they're doing an additional $164 million of dilution. The stock is actually right back to where it was when Bill initially invested, so it could definitely be a stock to look into for long-term growth. But again, I do think that it is quite expensive today. The price tag has not seemed to deter Bill Gates though, and he actually owns about 10% of the stock right now, and his position is worth more than $500 million, which is nothing to joke about. 10% is a huge stake in a company like this, so he must be pretty bullish along with Cathie Wood. Those are all of the moves that Bill Gates has been doing recently, and the rest of his portfolio is comprised of some pretty safe dividend stocks like Walmart, Coca-Cola, Caterpillar, and so on. Bill Gates seems like he likes to invest in more boring stocks that also provide some dividend income. I personally think that he invests like this to have some cash flow for the Bill and Melinda Gates Foundation, which brings me nicely back to the point I wanted to make earlier on in the video. I just finished reading Bill Gates' book called How to Avoid a Climate Disaster, and in the book he is very open about how many millions of dollars he is investing into many different climate technologies. He also says that these technologies need much more investment money, so it would not surprise me if he is selling some of his stocks that he believes are more on the overvalued side to help fuel more of these investments into private climate companies. I also plan on doing some videos on sectors and areas he thinks will be huge in the future as the world continues decarbonizing, because some of these sectors are going to be massive. So if you want to stick around and see those videos, then please make sure you subscribe to my channel to stay up to date with all of my future content. But that is pretty much going to wrap up the video, everyone, and thank you so much for stopping by and checking out my video. I would also love to hear all of your thoughts and comments in the comment section below. Do you guys agree with all of the moves that Bill Gates is doing in his portfolio recently, or do you think that he is selling stocks a little bit too soon? But with that being said, thank you all once again for checking out my channel, and I hope to see you all again in my next video.